in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Hello, welcome to Your Money, Your Call. I'm Julia Lee from Bell Direct. If you have a question about shares, our phone lines are open right now, so please give us a call. The number's 1300 30 34 35, or if you prefer, you can always email us on yourmoney@skynews.com.au. And joining me on the panel tonight, we have Evan Lucas from IG, and also for the first time, Fraser MaCleod from Morgans Financials. Welcome to the program.
Thank you.
Been lots to talk about. We've started off the new year, 2014, and unfortunately we're not off to a good start. 9 sessions so far this year, and 7 sessions have been down. I mean, Evan, looking at the market, is this any indication of what the rest of the year is going to be like?
I don't know about the rest of the year, but I certainly know the next quarter and what probably to look at that. Unfortunately, at the moment, we are sort of looking at a situation where we could actually have the worst start to the year since 2010. And if we continue to lose the amount of sort of points we lost today, which was 80 on the ASX, we could be in line to have the worst January month since 2009, which was the very, very tail end of the GFC, when we lost another sort of roughly around about 8% in that January month before we saw that pick up, and that really bounced. So at the moment, unfortunately, there's a lot of things going on. There's nervousness in the US about earnings. We've got China next week with all their GDP data, industrial production, and fears about their slowdown and credit growth. And then there's Europe that's sort of bumbling along. And all of that at the moment, unfortunately, is creating a little bit of nervousness. Do remember, it's January, and therefore it is low volumes and seasonality is there. But I think for the next quarter, particularly heading into that February first half earnings, it's going to be a little bit rocky. And at the moment, we're experiencing quite the rocky ride as it is.
Okay, so 3 months you're predicting a rocky road. I mean, Fraser, looking at the market, and are you positive on 2014? What's your view?
I think, yes, we are positive on 2014. The market is not desperately cheap anymore, but it trades on around about 14.5 times this year's earnings. Now, that's perhaps a little above the average, but there are reasons to remain and stay bullish in 2014. The RBA has kept the interest rate very, very low, so we'll probably see a lower for longer market. We also have an improved housing market here in Australia, and that'll be good news for the stock market. And there is less government risk now that the election is over. So we see the market pushing ahead, perhaps not as much as it did this time last year. And perhaps by the middle of the year, 5,500 points, and then by the end of the year, 5,800 points. We prefer more cyclical stocks for this year rather than defensives, but it's really all just about weighting your portfolio for 2014.
Okay, so it looks like a rocky start. I mean, looking at the rest of the year, are you seeing this as an opportunity to buy stocks and accumulate stocks, or are you just holding back? I know you have a lot of traders at IG.
Well, you have a lot of traders at IG, and look, obviously we have international shares as well. But I think coming from an Australian-centric point of view, and that's what I do, there is probably a bit of a screaming hold at the moment on the market. There is a buying opportunity coming. And I think if we do go back to about 5,000 points or below, that's certainly there. And there is, right now, there is still a lot of stocks out there that do say, yes, please pick me up. If you're a medium to longer term investor, particularly in energy, particularly in those cyclical plays that will probably benefit from a better news story out of China, which I think is coming. I don't believe the doom and gloom of some of the calls that are coming out of China, and they're the ones that are certainly there. Again, like every year, the ASX, you've got to remember, it's not a hugely diversified market. It's not a US. It's not a Europe, unfortunately, as much as we'd love it to be. And that's why we're always going to be a stock pickers market. We're not an industry market. We're not a sector market. You've got to be clever. You've got to be advised. And that's why Australian investors do what they do. They are very, very savvy in how they invest, and that's what this year will be again.
Okay, lots of time to talk about what's in store for 2014. We do have an email that's just come in from Les, and Les writes, "Hi, can the panel advise whether it's the right time to buy into gold stocks?" Cheers, Les. Good question by Les, because that's the one area we've actually seen quite positive in 2014. Now, the year-to-date so far, you know, we've only seen 9 sessions, but gold is actually up by 4.1%. And a lot of analysts saying, you know, physical buying is helping to support the gold market, and we're going to see strong support going into the Lunar New Year, the 31st of January, with Chinese buying a lot of gold. So Is it the time to buy into gold stocks, or is a gold run over? You know, last year was the worst year that we've seen for gold since 1981. What do you think, Fraser?
Look, we think most definitely the run in gold is over and was over a long, long time ago. Our chief economist, Michael Knox, is desperately negative and remains very negative on gold. Now, gold is driven by the price of the US dollar, and if there is inflation in the US, then the price of gold will go up. If the US has a large expanding budget deficit, then the price of gold will go up. But the problem is inflation in the US is incredibly low. Inflation is around about 2%. The US budget deficit is half of what it was back in 2009. So the price of gold is going down. And that's a big problem for gold if you're holding it, but it's also a big problem for a lot of gold stocks. So no would be the answer on that. If you had to hold a gold stock, then maybe hold something like BDR, Beetle Resources, because they've got some iron ore credits. And if your life depended on it, you needed to hold it, then maybe hold that because their cost of production is low and they're probably going to be last man standing. But there's going to be some death in the market in gold this year.
Okay, so don't like gold. Do you have the same opinion, Evan?
I do, unfortunately. I was hoping to sort of maybe have a bit of banter with Fraser, but I'm also the same opinion. Again, it gets back to what's going on in the US. You've got a situation also now where the US dollar is on the appreciation side, and from a trading perspective, and that's what we at IG look quite heavily, paper trading, the gold on a medium to longer term view is fundamentally under pressure because the US dollar becomes an investment currency, therefore bonds become an investment situation. And if you're looking at an inert metal that doesn't give you any returns and you're an investor, and that's what most people in gold are, paper trading anyway, they're going to look to bonds, they're going to look to currencies, and for that reason gold is under pressure. I completely agree also with Fraser. Beetle's the one I'd look at. You may also look at some of the other lower producing plays like Northern Star. They're out there. You can also maybe have a look at one or two others. Maybe you could throw Sandfire Resources in there, but again, it's got copper and iron ore credits, and that's why it's probably more of a benefit. Look, there's certainly going to be a pop, and you can see right now that because the market's under pressure, people are running to safety, and that's what gold is. But medium to longer term views, gold does certainly look like it's going to be under pressure. I don't think it's going to be dire, but I don't think you could see the $1,600, $1,700, $1,900 you saw in 2011 anytime soon because the fundamentals just aren't there to support it.
So I'm not going to see another year where we've seen gold up 77% during QE1. It looks like the US dollar going in the opposite direction, and unfortunately that's not good news for gold. Let's go to our first caller of the night. We've got Peter on the line from Hobart. Peter, welcome to the show. What's your question tonight for our panel?
Oh, good evening, Julia. I was just quite surprised because I was going to ask about Northern Star, but it seems to be covered. But then again, I was reading an article about the comics exchange over in New York where they've got a record number of short sellers. So what does that throw into the mix?
That's a good question, Peter, because I guess looking at gold, you can look at it from a short-term, medium to long-term perspective. And, you know, looking at Northern Star, it's one of those companies that's just had a stellar track record. They bought the Parsons mine back in 2010. I think they paid it off within 7 months, and for a long time they didn't have a lot of debt. And, you know, I think there's a fully franked yield of around about 5%. So unlike a lot of gold miners, it pays a dividend. It's a fully franked dividend. So Northern Star, Evan, is this...
Yeah, Peter, I probably sort of cut you off a little bit close there because I actually, Northern Star, out of Beetle and Northern Star, the two in the gold space that, if you want to, you know, put a bit of a pun out there, are the bright spot out there. Northern Star have found in FY12 and FY13, they've actually started to get positive net profit up to around about $36.7 million last year. As Julia alluded to, they are a low-cost producing entity, and they do have good tenements. The unfortunate part about them, as we just alluded to, is that they are tied to the commodity gold, and gold over the next couple of years is probably under a rough period. Don't believe that it's going to be the end of gold. Gold will always be there. The two biggest demand places for gold is China and India, and that will always be the same, and that's never going to really change. And physical gold trading, you can see that. Northern Star will therefore have some translation into that. I do like the stock, and if you have a look on a fundamental basis and also at the moment on the technical basis, you can see since basically the low last year in June, when it was basically tracking what was going on gold, the fundamentals have started to come through. It had a really good number in June, and it's been picking up, and it's jumped up from, you know, it's almost up just under 50% if you have a look at that, and that is good momentum. That means the market is looking at it from a company perspective and a stock perspective rather than just the overlying idea. So I do actually... I do like Northern Star. I want to see what happens in in the first half earnings of this year. If they can come out again with maybe 15 to 16 and if they could even go as good as 17 million, that would show that they're actually growing, and that's a 6 to 8% growth. That in gold's amazing at the moment, but considering the amount of pressure that they're under, that would be amazing. So if they could get out with a really good fundamental number, then yes, I'd probably be quite happy with them.
Some really good points coming through from Evan around Northern Star, but I guess the key is still the gold price. I mean, looking at Northern Star, it's one of the lowest cost producers, but it's still got all-in sustaining costs of about 1,000 US an ounce. Gold prices, you know, it's about 1250 US an ounce at the moment. Still a nice margin, but you know, if that gets eroded further.
It does get eroded further. Our target over 2014 is for the gold price to get to $770, which would be horrible. So you know, that would send most gold producers globally, you know, into a very negative situation. So,
and that's solely on the basis of the strengthening in the US dollar?
It is, yes, it is.
Wow. It's one of the most bearish forecasts I've seen in the market. And on that note, we're taking a short break, but we'll be back to answer more of your questions in just a moment. Welcome back to the Shares edition of Your Money, Your Call. We are still taking your calls on 1300 30 34 35, and of course you can email us yourmoney@skynews.com.au. And we've got David from Sydney on the line. David, welcome to the show. What's your question tonight?
Well, thanks, Julia. I've got a question about a mid-cap miner that tends to fly under the radar a bit, BC Iron. It doesn't get, as I say, much attention, but if you look at its metrics, they're extremely strong, and I know that these sort of miners aren't in favour at the moment, but I'd just be interested in the panel's view on this. And it actually pays on a historical basis, 7% dividend as well. So just be interested, as I say, in the panel's views on this particular one. Okay,
so having a look at BC Iron, this is actually Bell's top pick in that smaller space, Fortescue being the top pick in the iron ore larger space. But, you know, bottom half of the cost curve, very little to spend in terms of CapEx. What do you think, Fraser?
Look, we like most of the iron ore providers, and especially iron ore in Australia. We certainly believe that iron ore in Australia has a cost advantage. There's a lot of focus on the iron ore price in terms of daily spot price movements. And when we look at the price of iron ore at the moment, around about $130 a tonne, we believe that it's going to stay at that level for most of 2014. There is some seasonality involved. It might be a little bit less, it might be a little bit more. BC Iron will certainly benefit from that. Our preference is for the majors, as Julia said, you know, companies like Fortescue, companies also like Rio Tinto especially, at the lowest lower end cost of production we prefer. So the steel demand is set to grow probably by around about 2 to 3% in 2014. China is obviously still growing. We believe that China will grow by around about 7.3% as well in 2014. And I would stick to the lowest cost producers in iron ore, and I would include BC Iron in that. It might be a little bit more volatile. It does pay a reasonable dividend, that's true. So yes, I would be a holder of BC Iron.
Okay, holder of BC Iron, but would you be buying? It does look like it has topped out at the moment, Evan. I mean, looking at the share price, just recently we saw the share price reaching its highest level ever by the looks of it.
It's had a fantastic run up, hasn't it? And you can have a look at, and the reason for it is that, particularly if you look at the financials that happened in 2012, that was its real best year. It really cracked out. Earnings per share hit 50 cents. You got a net profit hitting $60.8 million. Last year was a little disappointing, and that's you know, you can understand why that was. We did see a little bit of shake-up in that iron ore space, particularly towards the back end of 2012. Fraser just alluded to what I think will happen this year, which is the back end of 2013 was quite nice. I'll look at it technically, and you can see there is a breakdown, particularly at the end of December, the start of this year. It's been under a lot of pressure, and that is probably, again, coming down to what we're seeing globally rather than actually the stock itself. If you are a real bull on this stock, and it sounds like David probably was, and I can understand why, it's certainly a great little play, and it is cheap. There's a possibility to really have a look at it on a technical level. 450 looks like a real sort of point, and if you have a look back to probably August, September last year, there was a bit of a resistance level there, and it broke through, he smashed it and went all the way to that high point. So if you look at it from a technical level, David, I agree with the fundamentals, they are there. I think you probably see a nice little result. Look at it from a technical point of view. If it trades back to $4.50, that may be a signal for you to have a bit of a consideration to pick it up. I wouldn't yet, because I can see that is a bit of a falling knife graph, and from a technical point of view, and technical analysts don't really like that kind of fall because they don't believe it's finished, and that's probably what we're going to check out. Again, I always want to see both fundamentals and technicals, and currently the technicals probably don't back a purchase right this instant.
Okay, so short-term fundamentals looking quite bearish. I mean, Fraser, you said you'd be holding. Would you be happy buying at these levels, or would you be waiting as well?
I probably wouldn't. I'd probably wait, especially because it is a mid-cap. It's a slightly more risky play, so I'd probably wait.
Okay, so what price would you be happy to pick?
Sure. I'd go with Evan. I would go for a slightly lower price. This is a stock that on BCI that traded an awful lot lower by last year. They were trading at $3, and they did have a big run up to above $5 a share. So I would agree with Evan. Around about the 450 level would be a reasonable price, technically and fundamentally, to be having a look at the stock again.
Okay, so that was BC Iron, very attractive mid-cap iron ore stock. BCI is the stock code there. It's time to go on to our next caller. We've got Ben on the line from Sydney. Ben, welcome to the show. What's your question tonight?
Hi guys. My question is, I'm looking for a stock to hold on, say, a medium-term basis, perhaps a year or so. And I've been listening to a few of the forecasters, and some have suggested Bendigo, Amcor, and ComputerShare. I keep hearing sort of bandied about, and I'm just wondering which one might be the panelist pick, and also what might be an appropriate target or a stop loss to set for these stocks.
Good question. Bendigo, Amcor, and ComputerShare. Yeah. So three very different stocks. I mean, ComputerShare and Amcor obviously have the FX exposure, probably working in their favour. Bendigo Bank, one of the regional banks, typically struggled against the big four. But is this the year for the regionals to come fighting back? Evan, what would be?
I'll take the first part of that question. So I'll have a look at the Bendigo Adelaide Bank for you. I think at the moment you've got to look at those regional banks, at the pressure that they're under. You've seen probably Bank of Queensland be the one that was slightly more in the news last year, even though Bendigo and Adelaide Bank actually tracked it all the way up. The issue with them is the net interest margins, and that's always going to be the issue with the regional banks. They have to compete against the four largest, and that's what they always complain about. They're currently trading between 150 and as high as 180 for Bank of Queensland on net interest margins, where the lowest big four bank is NAB at 2.07. So already they've got a leg up on that. They've got a bigger market share and the ability to do that. That's why you see their dividends high, and it's why you see them more probably talked about. If you have a look also at the graph of Bendigo and Adelaide Bank, it's had a fantastic year. There's no doubt about that. It got back up above $12, something you hadn't seen since the GFC. And that, to me, also suggests that it could be overbought in terms of what it's at because of the operations it's in. But the Victorian South Australian market is still a little bit dicey. I think if I was going to look at it, Queensland would be one I'd look at. And then again, that's why I would probably stick to one of the bigger banks, particularly something like ANZ or NAB that has not just domestic exposure but international exposure. It's got better capital management, and ANZ obviously has got a net interest margin of 2.25%. So all of that works in that favour. So for that reason, Ben, I'd probably look at maybe the other four banks. I'll let Fraser talk about maybe Amcor or ComputerShare if you want to. Or
so Fraser, ComputerShare, Amcor or Bendigo, what would be your pick?
Oh, look, I don't mind them all for different reasons. I think that Bendigo, obviously regional bank, but they did have a few legal worries recently, which now seem to be resolved. Bendigo is trading on a reasonable PE multiple. It also trades on a pretty reasonable yield, fully franked. Probably our key pick would be to stick with the majors and to stick with the likes of NAB and ANZ, which are more corporate lenders. Bendigo is more of a regional lender after all. On Amcor, which I think we spoke about, packaging in 42 countries. Recently, there was a demerger from Amcor, so now Amcor has a bit more of a revenue exposure. Around about 30% of its earnings come from overseas, and that's only a positive. Amcor trades on 16 times this year's earnings. Now, that's a pretty reasonable multiple. You'll get some growth out of the stock. So at 3.9%, it's a pretty decent yield as well.
Okay, so that was Amco, Bendigo and Adelaide, and ComputerShare, it's market related. Market's finally looking like it's on a bit of a trend up, even with the short-term weakness that we've seen in 2014. So looking pretty good, and of course it's also an FX play. We're taking a short break, but we'll be back to answer more of your questions in just a moment. Welcome back to the program. If you have a question about a stock or shares, our phone lines are open and we'd love to hear from you. The number's 1300 30 34 35, or you can email us on yourmoney@skynews.com.au. And we've got Raj on the line now from Melbourne. Raj, welcome. What's your question tonight? Hi, Raj.
Yes.
What's your question tonight?
You are talking about some cyclical stocks. Do you have any preference for any particular types of cyclical stocks? Can you talk about that, please?
Sure. So I think Raj is asking about cyclical stocks. What do we mean by cyclical stocks, and what would be our top cyclical picks in the market? And I guess when we have a look at the market, we do tend to separate stocks into cyclical or defensive stocks. Defensive stocks tend to be those stocks that do well regardless of what the economy is doing. And there's stocks like telecom, utilities, because whether the economy is good or bad, people still need to use their telephones, they still need electricity. On the other hand, cyclical stocks are stocks that are typically tied to the economic cycle. So when the economy is good, cyclical stocks tend to do well, and when the economy is bad, they don't tend to do so well. These stocks tend to move in a business cycle, so they're typically areas like retail, housing, even the commodity stocks tend to move in cycles as well. Now, the top cyclical stocks on the market, probably best to ask our panellists tonight. So, Evan, what would be your top picks?
My top cyclical stocks, and Raj, good to hear you again, a regular contributor to this program. My cyclical stocks remain something I've had for a little while, and that's energy. Energy certainly is becoming a really, really big player, not just here in Australia, but globally, and that's why I really like it. And you can hear a lot of analysts talking about, and when you start hearing the big players like Shell, BP, etc., talking about gas being the next major energy source of the world, it gets me quite excited, particularly things like a Santos, like an Oil Search. Even Woodside is technically classified as a cyclical, and the fact that it's now moved also to a slight income play with an 80% payout ratio, looking to really up that idea. Pluto's online. That's probably your less risky of the cyclical plays. I like Santos. Santos has got a really, really amazing pipeline. PNG LNG comes online midway through this year. You've then got next year their big Gladstone LNG project, which already has offtake agreements done with Total, Kogas, and also Petronas out of Malaysia. So it's an Asian-focused story. Record natural gas prices. All of that's why I like the cyclical story in Santos. They've eased over particularly the last 3 months, and it's not on any news. It's just eased because the market is eased and it's gone with it, and it's had a cyclical cycle. It got up above 1580, it got a little bit excited there, and it's been sort of on the downward spiral on really almost nothing. And I know at the end of this week on Friday we're going to get their fourth quarter production numbers, and that will be very interesting because a lot of people talk about 2013 being a little bit weak on the production side, but if you look at their revenues, they were records, and that's what gets me excited because at the end of this year, CapEx will fall away with PNG coming online, and then you've got Gladstone next year with that CapEx falling away. All that looks very, very positive for a stock that is certainly a very cyclical play.
Okay. So, I mean, Santos looked like it peaked back in October. You're not concerned about that at all?
No, not. And again, it gets back to what we're just discussing. This is a cyclical stock, and it has those run-ups. It had a really, really good second quarter report, and that's what drove it. And then the fundamental and technicals aligned, and everybody sort of ran into it. The technical analysts are probably having a bit of fun now, but if you look at the volumes trading, particularly since the end of December, it's incredibly low. So I'm not worried that this has been a pullback. In my eyes, it's probably possibly a buying opportunity.
Okay, buying opportunity. But look, the oil price also peaked just before October when Santos's stock also peaked. So back from 110 down to around about 90 US barrel. That doesn't...
Yeah, again, it gets back to what you've got to remember that 70%, just under 70%, comes from gas. And natural gas was up 34% last year. And if you look at British thermal units, it's at a record. I mean, a lot of people talk about the fact that the US shale gas is coming and whether or not it's going to be cheaper, more expensive. There's articles that have come out in the last 24 hours that are suggesting actually Australia's going to have a cheaper opportunity than those US gas. So yeah, it's an exciting place. That's why it's a cyclical stock, and that's why it's an exciting area. So I'm not saying there's no risk to it, but I'm not upset with it.
Okay, so Evan liking the oil and gas space, especially Santos. Now, I want to spend a little bit of time on these cyclical stocks, but we have run out of time and we do have to go to a break. So please stay with us. We are going to come back to Fraser and get his cyclical picks for 2014, and we'll be back with more after this short break. If you'd like to speak with our expert panel, our phone lines are open. Please give us a call. The number's 1300 30 34 35, or you can email us at yourmoney@skynews.com.au. Welcome back to the program. Joining me on the panel tonight, we have Evan Lucas from IG and also Fraser MaCleod from Morgans Financial. So if you've got a question you'd like answered, please give us a call. The number's 1300 30 34 35, or you can always email us, yourmoney@skynews.com.au. And before the break, we were talking about cyclical picks for 2014. Evan liking the oil and gas stocks, especially Santos. Now, it's your turn.
Sure.
What do you like, Fraser?
I would agree with Evan on energy picks. I think there will be greater demand for some of the LNG plays. But if you want to play the cyclical upswing, we also like the retailer Harvey Norman. Now, Harvey Norman, everyone knows they make their money from selling electrical goods, furniture and the like. and we believe it's one of the best plays in order to really reap the reward from the cyclical upswing. They are leveraged to an improved housing market. The margins seem to be holding up quite well. There is strong earnings growth expected without having really to pay too much, crucially, for the stock. Now, on my screen, they trade on around about 17 times next year's earnings, probably a 3% cash yield, and fully franked as well, that'll be translate to about 4.5%. So we do like Harvey Norman. It's been a long time coming, the recovery in Harvey Norman, but we believe that certainly the stock is a great place to be.
Any other stocks?
Upswing. Rio, we like an awful lot as well. The iron ore miners we would certainly prefer, and I would also agree with Evan that some of the energy plays would also be worthwhile. You could also look at other retail discretionary plays, maybe JB Hi-Fi, a bit cheaper today. They might be worthwhile to pick up some while you can get them on a slightly cheaper multiple.
Okay, so generally, I guess when people think of cyclical stocks, they think of the retailers, they think of the media stocks. What about the media stocks? Is this going to be the year for, you know, the
It was.
10, 7?
It was. I was really excited by Fox. And the news about them possibly delisting. Obviously, it's got to go through shareholder approval, but it looks like a fairly foregone conclusion. I was very excited by that, and that would have been a very exciting stock to have a look at because massive US earnings. It was having an incredible run in terms of advertisement dollars with their new programs they've got over there, particularly the launch of Fox Sports, also FXX over there, and FSI. You could all these new channels that were really targeted to very niche markets, done incredibly well. That's now clear. Organic growth was up around about 16%. All that was looking really nice. So in the media space, Fox was the one I had. Unfortunately now with that sort of translating offshore, you could look at News Corp, but again, News Corp have some interesting situations with regards to whether or not the newspaper assets are actually translating into any sort of, you know, returnable sort of funds that you actually want. Yes, they've got $2.1 billion of cash on the balance sheet to do with, but it's unsure of what Rupert Murdoch's going to do with that, and that's why. And then you can go 9, 10, and 7 still have fundamental issues. Debt, and more debt is the way I can explain those three, and that's why at the moment for a pool of $2.8 billion of advertisement, for those three to be fighting each other with the debt that they have, it's very hard to get excited.
It's hard with the media stocks, but maybe some of those retailers, especially those ones that are exposed to the housing space. Let's go to our next call. I've got Dean on the line from Melbourne. Dean, welcome. What's your question tonight?
Yeah, my question's on ResMed. I've recently sold out of a lot of top 50 stocks, the major banks, the miners, CSL, and I've been buying ResMed over time, and it's actually my largest holding at the moment, so I'm actually after a technical and a fundamental on ResMed.
Yep. Sure. I mean, ResMed, quarterly results have been absolute records, but the stock looks like it's peaked back in October around the $6 mark, and we've seen it pulling back to about the $5 mark. So that's a pretty steep fall, around about 20% since October. So the technical view is going to be quite interesting with ResMed, and then the fundamental view as well. So, I mean, Fraser, looking at ResMed, what do you reckon?
Sure. Look, I'm more of a fundamental guy than a technical trader, but from an investment point of view, ResMed looks okay. Obviously, sleep devices, their 5-year average PE is probably around about 20 times, so you need to watch and make sure that you don't pay too much money for ResMed. It is a good US dollar earner, and that's the real reason to be in the stock in 2014. So we don't mind it, but if you could get it perhaps a little bit cheaper so that fundamentally you weren't paying too much of a multiple for ResMed, then I'd probably be a little bit happier. It can also become quite a competitive market that they operate in, so but longer term we do like the earnings growth that should be delivered out of ResMed.
Okay, and I mean, there's so much more education around the impact that sleep apnea has on your general health, as well as heart disease and things like that. So fundamentally, the story's great. Technically, you know, we're seeing lower lows, lower highs.
Yeah, and it's
downtrend. What do you think?
Yeah, look, I normally do fundamentals as well, and I really do like the stock. It's got unbelievable. Looking at it technically, you can see right now that it's really testing what was in May, June last year, a level that it was really interested about, and that was that $5.10 to as low as $4.80 level, and it really traded through that. You can see there was reasonable volume. You got an interesting update at the end of October. There was obviously that change of record financial numbers that didn't necessarily shoot the lights out, and that's why it's come back. Technical trading's turnover, and Dean, I really like it from a technical perspective if you see the support at that $5 level. If there's a really good support level there, you can see in the last couple of days it's actually had higher volumes and another lower low, and that's a little bit concerning from a technical point of view if you want to look at it from that perspective. I think you may see it break through the $5 level, and it could head back to what you saw in June, July, which was around about a low of around about $4.60. So for that reason, Dean, it's a great stock. You've done incredibly well because it obviously is your biggest holding, and I really do like it on a longer term basis because of the US dollar holdings. 95% of earnings come from overseas, so keep that in mind. I think if you sound like you're going to add to it, watch it from a technical level. Under $4.80, I think, is when you may see the support coming back, which is what you saw in May, June last year. And if you go back even further, at the start of 2013, when it had a pop, that's where the resistance level was. So just be aware of that. Technically, it does look slightly weak.
Okay, so I hope that helps you out, Dean. That was from both a technical as well as a fundamental level. It is time to go on to our next call. I've got John from Sydney on the line. John, welcome. What's your question tonight?
My share is BAU. Is it a hold, or are we going to get out of it?
Sure. So looking at bauxite, BAU is the stock code. I mean, the stock did well today, up by 8.3%, but I think we have seen a lot of these ore players doing well because of what's happening in Indonesia. It is a much smaller stock, only $30 million market capitalisation, so we won't spend too much time on it. But Fraser, what are your thoughts on this one?
Look, small caps depend on market conditions, company announcements, the more speculative nature of the stock itself. So we have to always remember that liquidity isn't going to be there. Sometimes it is, sometimes it's not. So in demand at the moment, but may not be next week. Also remember, within a portfolio, it's really, we have to make sure that we water the plants and not the weeds, and sometimes some of these small caps haven't really done terribly well. I would stick towards some of the bigger plays if you are looking for exposure in that area. I would prefer probably to steer away from bauxite. It's a liquidity problem for me.
Okay, so staying out of the way of bauxite, but I mean, Indonesia's ban of raw ore exports is really helping stocks like alumina, which was up another 4.8% today. Bauxite, even though it's mostly exploration, up by 8.3%. Yep. Would you be getting into this space based on, what's happening in Indonesia and the price action we've seen in the last couple?
I think the way you can probably answer this, look, bauxite is a tiny little company. It's 30 million to 27 million, depending on what metric you want to look at, market cap. So it's very, very small. You can see that in the trading. It's very, very light. If you want us to talk about Indonesia, Indonesia is an interesting one. I think you could probably look at the nickel plays better than the bauxite. Bauxite ore is one of the things that they have banned, and that's why that major spike came up in the last 2 days. And you can see the volume is also a little bit higher than usual. That's probably a lot of traders trying to see if they can pick up on the Indonesian story. The Indonesian story is an interesting one, particularly things like Mirabara nickel, western areas. They're the ones that have really, really benefited from this, particularly western areas, because of that Western Australian mine. I think the one thing you may see in February is that the fundamentals running over the stock and the Indonesian story, because nickel price has been under so much pressure, and it is certainly a very, very expensive place, and the demand out of China for nickel is still on the way out, even though stainless steel is certainly something they want, and that's why I'm a little bit concerned. Look, I must admit, don't know much about bauxite resources. Apologies for that. Again, it's run up on the Indonesian story. That may be your answer if you are looking at it from a hold to maybe a moving away idea.
Okay, so Indonesian story, probably more of a short-term supply spike than anything medium to longer-term. Market's probably going to move to fill that gap if we do see a longer-term ban. And on that note, we're taking a short break. We will be back to answer more of your questions in just a moment. Stay with us. Welcome back to the show. If you have a question you'd like answered, we'd love to hear from you. The number's 1300 30 34 35, or you can also email us on yourmoney@skynews.com.au. And we've got an email coming in from Ray, and Ray writes, thanks for an informative program. Is Ramsay Healthcare a reasonable buy at current levels? I'm looking for some capital growth and planning to hold medium to long term. So looking at Ramsay Healthcare, I mean, the stock's been on an absolute tear. I think the stock's just hit an all-time high today. Fraser, what do you reckon?
Look, it's a fabulous business. The Ramsay run private hospitals. But it's very, very expensive, and I reckon at 29 times, let's just call it 30 times this year's earnings, on a 1.8% yield, I'd probably be a seller. I think it's probably time to take profits in Ramsay. It's a very, very well-run defensive business, but everything can get too expensive from time to time. So there was a few problems with Medibank over how the funding should go forward, and because of that, and also because of the fact that it's fundamentally quite an expensive stock now, I'd probably stay away. I'd be a seller.
Okay, so selling out of Ramsay from Fraser. How about you, Evan? I mean, there's a growth option of France.
Yeah, France is one in there. Look, the psychiatric. This is the issue with Ramsay, and this is a bit of a question that's coming on Your Money Your Call on a regular basis at the moment about Ramsay and what to do with it. It's an amazing stock. It's had a fantastic run up. If you look at the EPS growth, it's fantastic and it's steady. It's around about 10 to even as much as 12% over the last 5 years. That's a great story on a fundamental basis if you want to look at it from that perspective. France is an interesting one because that suggests how they're going to have to grow, and that definitely comes from acquisitions. Organic growth looks fairly full, and there's a market saturation, particularly here in Australia, and that's what you're seeing, and that's probably why at the moment it's hitting a bit of a roof. If you look at it from that perspective, you can see there's starting to be volume running out. Yes, it's seasonality as well, but the volume at the end of last year was running out, and that would suggest that people are getting a little bit concerned about how toppy it is, and for that reason you can see that it's still making higher highs, and that's the one thing to be aware of. Technically, it's still going with the momentum, and momentum's an amazing thing, even if there's no news. So that is to be there, but I think putting them together, just looks like there's a bit of a turning point, and that may be a reason to see Ramsay back to $40, and I think that might be the place that it comes back to. If you look at the chart, that's where it was sort of sat for a long time between October and midway through December.
Okay, so Ramsay in the past week has been hitting a record high, but a little bit of cautiousness given the valuations at the moment. Let's go to our next caller. We've got Andrew on the line from Sydney. Andrew, welcome to the show. What's your question tonight?
Hi, question to the panel, two stocks. The first one's Green Earth Energy, GER. Second one is Resonance, RHT. They've both had some good runs recently. Would the panel consider buying them at today's price? Sure. And what do they know about them?
Sure. So having a look at these two stocks. Now, these are very tiny stocks. I mean, Green Earth's only a $21 million market capitalisation. RHT is only $6 million. So I don't want to spend too much time on these stocks, but I do want to deal with how you trade speculative stocks. Because looking at Green Earth, I mean, this is a stock that's just shot up today, 240% on the back of news that has come out, some Israeli breakthrough with one of their technologies in regards to renewable energy. It shot up, but where does it go next? How do you trade something like this? Or if you're an investor in a speculative stock, often you get an announcement, the stock spikes up, and then often it can come all the way back down, or it can continue on. What tools do you use to evaluate, Evan?
With regards to sort of speculative stocks, particularly these kind of stocks, so as you said, Julia, this has been a spike up on a news announcement. And if you actually have a look at the news announcement, yes, it's with regards to CO2 capture and something similar to what they do, but it's not actually necessarily part of their complete business model. So that's one part. So if you look at it from what they actually do, interesting side. From a sort of a trading perspective, you can certainly ride the momentum, and if you can see a news story generating the kind of volumes you saw this morning, and if you wanted to be really fast and you wanted to do a day trade idea, you could see that news this morning. It was released halfway through this afternoon. It was put into a trading halt, came back out, and there was a real big spike. You could probably trade from that perspective, and it may be an in and out story because people will start to digest this and have a look at how that is. Again, if you actually go back on the share price, probably to midway through 2011, which is what you're going to have to do to have a look at something like this stock, if we're going to talk about it, again, you could see the volume was building. And if you see momentum, volume, and therefore also things like Bollinger Bands touching the top end of the Bollinger Band, that's the momentum sort of idea that you can actually look at speculative trade lending traders to actually start moving with it. And when you see those breakdowns, and you can see there was a top of it, it broke down and it went the other way. That's where you've got to have fast-moving ideas and fast-moving trades. So speculative things, you can use them, but be aware they're speculative for a reason and they're high risk.
Really good point, because, this spike up's been amazing today, but looking back in time and looking at a 10-year chart, I mean, the stock was at around about 30 cents back in 2008, and, even with the spike up today, it's at about half that price. So really, you've seen asset price deterioration on a longer-term time frame, and you had to be a little bit nimble to be able to get these spikes up. I mean, Fraser, looking at more speculative investments, do you like them, and how would they fit into a portfolio?
Look, generally, I don't like speculative investments unless they're quarantined investments. So it's okay to take a small proportion of your portfolio and push it towards something that is a bit more of a speculative buy, but be a little bit more cautious. the liquidity in the stock is going to perhaps cause some problems. So the difference between the bid and the offer, you know, you might buy the stock and then have to trade out of it. If you had to sell out of it, you might have to sell out in more than one transaction, which can always be a danger. Or you may have to settle for less than the indicated price that the market is offering you if you're selling out in one go. So that's where some private investors can sometimes go a little bit wrong. Perhaps they hold just too much of the stock. On Green Earth Energy, it's obviously a more speculative play. It's a developer. It doesn't make any money at this point in time, and it's never paid a dividend, so it wouldn't tick a few boxes for me. But you really need to watch and take at least an 18, maybe 24-month view over these stories, and then exit on news flow.
Okay, so that was a couple of smaller stocks which have done extremely well, but how they might fit into a portfolio, or how to even manage those big spikes up that you often see with some of those smaller stocks. Let's go to our next caller. We've got Richard on the line from Sydney. Richard, welcome. What's your question tonight?
Thanks, Julie. What a great team tonight. The question's on Rio Tinto. Fraser, I saw some Morgan's research, Reddit in the Fin Review about 3 weeks ago. Capital expenditure going down, interest burden decreasing with free cash flow increasing, with about $5.10 per share, earnings per share. Where do you see dividend growth going 15, 16 and possibly into the year 17? Thanks, fellas.
So having a look at Rio Tinto, I mean, what do you think, Fraser?
Yeah, thanks, Richard. Look, Rio Tinto is one of my favourite stocks for 2014, so lots to talk about there. It's a fabulous time to be looking at Rio Tinto, especially as it's quite a bit cheaper than where it was a few weeks ago. Now, 90% of Rio's earnings come from iron ore, so iron ore, in terms of where iron ore is going to go to this year, is going to be absolutely crucial. I spoke before that the world tends to look at the spot price of iron ore. It's around about $130 a tonne. There's a bit of seasonality involved, but as long as it stays at $130 a tonne, the extra volume that Rio Tinto is producing is really going to pay off this year. Rio Tinto are the lowest cost producer of iron ore in the world. It's a quality product, and China is still growing. So we like Rio Tinto. Ultimately, we think the Rio Tinto will reach $80 this year, so there's a good percentage upside. The dividend should grow. It's a progressive dividend, so the dividend yield that you get out of Rio Tinto won't be what perhaps you can get out of some other resource stocks, or some of the, in comparison maybe to some of the industrial stocks. But we do think that Rio Tinto is one of the key picks for 2014.
Okay. So now I was just looking at that chart, and technically, you know, at the end of that chart is a megaphone formation, which is quite a rare formation, but typically a topping pattern. So we've seen a break on the downside there at the $64 mark, so it means we've seen a fall from about 68 to 64, which means that would be a target of $60, which of course is previous support as well. Do you think that, you know, the iron ore miners, we are going to continue to see weakness? Yeah, I do. Again, it gets back to what we talked about at the start of the show. I think, unfortunately, at the moment, we've got a bit of a jaw situation with nervousness in the US, what's happening with taper, are their earnings actually supportive, is China slowing down at a faster rate than we actually know? All those questions always creates volatility, and the first ones to take that are always going to be the big miners, because that's where all that comes from. I actually think at the moment Rio is a fantastic opportunity to watch it go back to $60 and then pick it up, because also this week, again, we're getting talking about production reports. That's what makes this, at the moment, an interesting trading time, because all the quarterly Q4 results come out, and they tend to be, you know, the ramping up to the end of the calendar year, and Rio reports in calendar years as well. So that's the other way to look at it. It's a very interesting time for Rio. I think on a technical basis, it's breaking down, and you've got macro themes over the top. But if the production report is as good as what you heard out of Port Hedland last week, it'll be a real interesting reversal pattern point of view, and let's hope that is the case. So I really like Rio. I think the average price, if you look also in Aussie dollars, is amazing in iron ore. It's actually 145. So for that reason, look at it, but it's under an interesting pattern right now. Very good point from Evan. Big event for Rio Tinto on Thursday, coming out with its fourth quarter production numbers, as is Woodside Petroleum. So if you have them in your portfolio, tune in on Thursday. It is time for a short break, but we'll be back with more of your calls in just a moment. Welcome back to the program. We have our next caller on the line. We've got John from Brisbane. John, welcome. What's your question tonight?
Oh, hi, Julie and panel.
Hi there.
Can you give me the heads up on Capital Health, ticker code CAJ.
Sure.
They've got 52 clinics in Victoria and regional Victoria and Metro. This stock seems to suffer from a lot of volatility, like small caps do, but general opinion, please.
Sure. I mean, Capital Health, it's been a great performer over the last year, up 240%. It's in diagnostics, so things like X-rays, MRIs. Very quickly, Fraser, what do you think of this one?
Look, obviously the stock's done very well. I don't mind diagnostic imaging. Probably our preference would be for the larger cap primary health. The challenge with some of these smaller caps is that it goes well for a while and then perhaps the liquidity does dry up a little bit. Primary is a good value healthcare stock, and on 15 times earning, I would probably prefer that. But it looks like a reasonable business.
Okay, so it looks like a reasonable business. I mean, if you compared it to anything, you'd probably compare it to Sonic Healthcare. Yep. Which one would you prefer?
Okay, look, as John alluded to, and I don't know your situation, John, I'll say that straight off the bat, but you obviously were a little bit concerned by its volatility. It is an interesting business, and it's certainly got a very good niche business in Victoria. If you have a look at its net earnings and its EPS growth, it's been fantastic, and that's why that 200+% has happened. But at the same time, it also means that PE growth and PE expansion has been astronomical. It's at 235 times earnings. That's a very, 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 very expensive sort of stock, and that's why at the moment it looks like it might be breaking down a little bit. I'd probably have Sonic if you are looking for a lower risk. However, having a look at what you're seeing on the earnings and also on the technical basis, you can understand why people like it. If you're a trader, yeah, Capital. If you're an investor, probably look at Sonic for that reason.
Okay, so that was Capital Health. CAJ is the stock code, and that's all we have time for today. Thanks so much to our guests, Fraser MaCleod from Morgans Financial and Evan Lucas from IG, and of course to you, our viewers, for all your calls and your emails tonight. Until next week, I'm Julia Lee from Bell Direct. Have a great night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.